In earlier videos, we covered what constitutes a limited partnership and how investors can enter and exit these opportunities. Determining good versus bad opportunities usually comes down to a few factors. First, what do you want the investment to do? Do you want it to grow your equity egg? Do you want it to produce cash flow to live off of? Is it for tax benefits, or is it some combination of these? Once you determine what you want from the investment, look for funds or project-specific deals that meet those goals and also have a thesis that makes sense to you. What that means is to really dig into each area and each building type. Each geography has its pros and cons. Places like Kalispell and Whitefish are growing rapidly, but their economy is largely driven by tourism. Tourism can be a tough business, as we saw during 2020 with the pandemic. Bozeman and Missoula, on the other hand, are university towns with thriving small business sectors and a software tech presence. For some investors, that is a stronger long-term proposition. The trade-off is that your near-term cash flow in places like Missoula and Bozeman tend to be skinny. Investors often have to price in the future growth anticipated in rents to their offer price on an existing asset. That's especially true in the apartment world. As a result, cash flow is minimal in the first few years of the investment, with it picking up over time as population growth pushes rents higher. Generically, that is reflected in lower cap rates when acquiring existing assets. On the flip side, places like Great Falls have higher cap rates to start because they have slow or stagnant growth. Rents are not anticipated to climb there like they would in Missoula and Bozeman, so investors lean more on current cash flow rather than anticipated future rent growth to create cash flow in the future. As a result, cap rates on acquisition tends to be higher in places like Great Falls. However, your rents now may be very similar to the rent you have 5 or 10 years from now. There's also a trade-off in risk-reward by asset type. Apartments are generally safe, but the returns are generally lower. Office and retail are higher risk, but can also have higher returns if managed and marketed properly. Self-storage is similar to apartments in many ways. Industrial warehouse is increasingly seen as a safe investment because of the shift to online commerce and demand for that product. Probably most importantly, when investing in these LP deals, you have to believe in the team that is sponsoring the project and their plan. Do they have the right experience, market knowledge, access to data, management plan, etc.? Do you trust them? Do others trust them? Only you can answer these questions when it comes to entrusting your investment in a limited partnership. Thank you for watching. Contact us at the link below for more information on limited partnerships.